Good day, everyone. Thank you for joining us once again here at Seafood and Brew for our weekly briefing. I am Jamie Sumner, Chief Analyst, and for this week's briefing, we want to go over the employment situation report that came out last week and also look at the yield curve and how it has been changing. And then follow that up with a look at where the average and high rate of the savings, money market, and CD rates are at this time. Because I do believe this is and you've heard me say that, this is a topic that we're going to have to broach as we move throughout 2018, the deposit rates. So overall, when we look at the employment report, you can see that we generated 103,000 jobs, a very big decline from where we were last month when it was over 300,000. So we had this tremendous decline as we come into April. And finishing up March, coming to April, that March number at 103, below that consensus at 175. So we keep that into consideration, how we came below consensus in there. When we look at the types of jobs that have been created, and we mentioned this last month, we saw a good distribution in those jobs that were created, now revised up to that 320,000. But when we look at March, the total private at that 102,000 jobs, we can see some negatives here. We saw construction, which has led the overall increases over the past couple of months. We saw that actually show a decline there, decline by 15,000. So we want to keep an eye on that and see if that continues or if we kind of reverse here in April when the numbers come out and go back to positive. But we continue to see the manufacturing producing 22,000 jobs, and we've seen that positive over the past couple of months, and that's a good sign. When we look at the servicing sector, we can see 11,000 jobs in the overall wholesale trade. That's a positive. A detraction is that negative 4.4 thousand job decline in here for the retail trade. So something to keep an eye on there. We had a big number in February at that 47,000. So a little bit of a pull off, maybe not too surprising. But overall, when we jump down to that business professional at 33,000, still showing that growth momentum in here. And as usual, that healthcare and social assistance at that 33.8 thousand, continuing to churn out these types of jobs. And that's an important thought process, especially with the changes in the whole healthcare system. So overall, when we look at the distribution, we do have a good distribution. We do have some detractions in here. We just want to keep an eye on that moving forward. This is only 1 month and it will be revised. So I'm a big proponent of waiting and seeing if there's a true trend that is occurring here. When we look at the average hourly earnings, we can see that is up 2.7%, just at consensus of the 2.7. No real change in the average hourly, average hours worked, staying at that 34.5. When we look at history in the average hourly earnings, right now at that 2.7, you can see the overall trend from where we were back in 2013. This is the year-over-year change. So we have an upward trend, but notice almost from 2016 on forward, it's kind of been a little volatile and overall has been moving sideways, basically. So that's where we've been. So no real true change when you look on trending averages here. Plus, when we look back into history, we can notice that during the recession and pre-recession, that average was closer to 3.25 in there. So that's significant. We're still running well below our typical wage inflation. With that being said, we can look at the unemployment rate continuing at that 4.1%. A highlight though is that U6 actually went down 0.2% from 8.2 to 8.0. So that is a positive. We see those those discouraged workers and those marginally attached workers starting to decline. And so we see that spread between the U3, the official unemployment, and the U6 beginning to narrow. Jumping from the employment situation into the yield curves, we can continuing to see the narrowing of the yield curve. As of yesterday, we saw that 10-year, 2-year spread at 49 basis points. So it's continuing to get lower, and you've seen the forward curves that we've shown before, and that trend with those bootstrapping of those current curves continues to happen out 3 years. We get down to under 20 basis points. So very, very thin margin here, or slope, a tight slope. And you look at where we were back in 2016, at the end of 2016, at 125 basis points. So we continue to see the short end of the curve being ramped up. That is obviously due to the Fed and their tightening strategy. Now, we have to take that into consideration when we look at our deposit rates, because I believe in 2018 we're going to see the need to increase those shorter term, those cash type deposits or core deposit types, money markets and savings, and even now accounts and checking accounts. So when you look at that, and we look at some of these now or the savings rate, and this is data as of yesterday on the 9th, and this is from a bank rate. Look where the average is still pretty low at just 9 basis points on these savings, but look at the best rate, 2%. Look at the money markets, average only 15 basis points, but that best rate at a 177. And we have to keep an eye on these rates, because this is what your customers are being advertised with, these large sticking out rates in here. So we have to begin to think about where we are in that curve with our current clients, and how we can maybe separate some of those hot money accounts with those sticky money accounts. And one way we've seen this work before is to add in there that additional account that gives you the ability to move that hot money over and increase that rate while not having to increase the broad base of your underlying deposits, because that is going to increase your overall level of marginal cost. It's going to be very expensive. So just keep an eye on these. We'll continue to update you on where bank rate is. You can go out bankrate.com and get these if you want on a daily basis, but we'll continue to look at this. That's what we have for you today. We look forward to seeing you back here next week as we explore more topics in the banking realm, community banking in particular. If you have any ideas of topics you want to hear, feel free to send us an email at info@seafreedombrew.com. Have a great week, everyone.